You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to another Profit from the Pros. I'm Terry Ruffalo. It was a mixed week for stocks in low volume trading as both the bulls and the bears looked ahead to the start of first quarter earnings season next week, hoping that these corporate profit reports will be the catalyst to push stocks higher. With little in the way of fresh economic data this week, investors' attention was focused more on the budget battle in Washington and the release of FOMC minutes, which underscored the Fed keeping its easy money policies and which offered more reassuring words on the economy and inflation. Another major earthquake in Japan on Thursday added yet another dimension of uncertainty for investors. Also on their radar was news the European Central Bank raised its main interest rate. And among what little economic news there was out there this week, well, weekly jobless claims fell by 10,000 last week, and wholesale inventories rose 1% in February, it was reported. Hey, let's welcome Steve Reitmeister back here for a guest appearance. You've been missing. We've missed you. It's great to have you back.
That's what foot surgery will do for you.
Yeah, yeah, that's true. You're actually also keeping an eye on the bond market here. Tell us why.
Yeah, with the budget battle taking center stage, not just the short-term budget issues, but the long-term deficit issues, bond investors are saying, okay, how serious are they about debt reduction? How serious are they about paying back this debt? And it looks like they're not very serious, okay?
Yeah.
And so bond rates are starting to move substantially higher at a pretty fast pace here this past week. And still they have plenty of room to go up, if people start to get concerned about our viability or ability to pay back this debt. And so I think that's definitely a story that needs to be watched.
In light of the ECB action this week, do we yet here have anything to worry about in the way of rising interest rates?
Well, most people are expecting the Fed's only got one direction to move on rates in the future because they can't move it any lower. So really, it is expected that sometime they will feel comfortable about where the economy is, where jobs are, and inflation, so on and so forth, to start letting rates rise. But yes, it is a leading indicator when other major central banks start raising rates. That usually is a leading indicator that we might soon follow. And it is, you can see in the bond rates that the expectations are going higher on that.
All right, let's talk about earnings season here as we look ahead in anticipation of yet another positive earnings season. Remind us why, again, this is a critical time for investors?
Yeah. I mean, we have to remember that, with all the charts and all the data points and things of that nature, when we are buying shares of companies, we are buying an ownership stake in those companies. And what owners care about when they have a firm is how much earnings am I going to walk away at the end of the day. That is how we value companies, is by that cash flow or earnings that get generated. So, this is the, 4 times a year report card that tells us how well things are going right now and how things should proceed into the future. And so it is that projection of the future that is most telling about what's going to happen with the stocks. That future looks great, stock's going to go higher. That future looks weakened or pathetic, that stock's going to get pummeled. Okay, so it is the most important time of year.
We hear a lot about the so-called whisper numbers during these periods during the year. What are whisper numbers?
Yeah, that's something that's been floating around there for a long time, and a lot of people have a different interpretation of what exactly the whisper number is. But the whisper concept is that, all right, so we know what consensus earnings are for a firm, but people might have a slightly different take. If they're more aggressive about the firm, the whisper number might be higher than the consensus estimate. Or if they think that things aren't as good as what the analysts had predicted, that's a little bit lower. So that's kind of like the behind-the-scenes whisper of what people are really thinking.
Okay.
How you capture that's the real trick. And most people have tried and failed in that space, and that's one thing that I think we're fairly proud about. I think we've captured a very strong leading indicator of where the whisper is and where real earnings are going to be.
And how important to investors are these whisper numbers?
Yeah, I mean, because most people are not aware of them or know how to read them, they're not that important to them. But if you do know how to tap into them, as we have found a way how to do, we can find earnings beats 77.8% of the time is what our studies show, that we can predict which companies are going to have positive surprises at an almost 80% clip. And that, yes, many of them will rise on that news, and it gives us a strong leading indicator of stocks that we can take advantage of during earnings season. And also, it helps us know what stocks to stay away from, okay? Because the last thing you want to do is be holding onto a stock that's going to have a terrible earnings surprise, a negative surprise, and see that stock fold apart on you the very next day. So I think we certainly have found something here.
Is there one thing investors can do to try to look for those whisper numbers?
Yeah. I mean, this is kind of the holy grail of investing, okay? So you're trying to get me to give away trade secrets. So if I'm dancing around on purpose because we are purposely not sharing that information publicly. However, with our Whisper Trader service, we are giving away the trades that we are finding based upon these specific whisper metrics, but we are not going to give away the secret sauce because that would give away our advantage.
All right, he won't be dancing at the round table, but he will be there. Stay with us. Here is your Bull and Bear Stock of the Week. An oil and gas driller and a leisure services company make up this week's Bull and Bear of the Week. Shiraz Mian here with me, our research director, to fill us in on the reasons why. Now, Helmerich and Payne, HP, the ticker, is the oil and gas driller. Big news with these drillers lately, right?
That's right. But HP is not as much a play on what's going on in the oil market, though it definitely has some relationship. It's more of an onshore driller, meaning that it drills on land, and most of the onshore drilling is geared towards producing natural gas. Okay. So it's more of a play on natural gas, and the fundamentals of natural gas are not as good as it is for oil. Yeah. But why do we have HP as a pick? Because HP stands out in the onshore drilling crowd for a number of reasons. Number one, they have one of the best drilling fleets out there. So there are high spec drilling rigs which does the job more efficiently in less time, less costly, which enables them to charge a higher price for it. And though the overall rig count in North America on the onshore side particularly is essentially plateaued and is stable, but HP, given the quality of its fleet, is able to gain market share. Margins are improving for two reasons. Number one, as I mentioned, the quality of the fleet, but also they had some long-running term contracts which are expiring. They are moving into new ones. The new ones are at a higher price point, and that's building into the top and bottom line momentum for the company. Estimates are going up. They had a good fourth quarter results. The outlook for the first quarter looks really good as well. Okay. And we think the momentum is on the side of the stock.
Okay. Carnival Corporation, CCL, the ticker, is the leisure services company that I referred to. Now, this one surprises me because I thought travel was picking up and people were beginning to spend money on cruises again.
It was before the stuff started happening in the Middle East, and we started seeing this is the flip side to the positive story that we had for the oil and gas companies. As you mentioned, fuel costs are up, and that's a major input cost for folks like Carnival. Another negative for them, they don't hedge their fuel exposure. And they're a global operator, one of the largest in the world in the cruise lines. Yeah. They have significant operations in Europe as well. And all those Middle Eastern and North African ports, which have been in the news over the last couple of months, those were destinations for these cruise lines. So they are forced to reschedule the itineraries, and that's weighing on the European outlook. The supply situation in the Caribbean is more than it has been in recent years, which is putting pressure on prices. So it's a good stock. It's a well-run stock. It's geographically diversified. They pay a good dividend, but the near-term outlook is cloudy. Number one, because of what's going on in the oil markets, and number two, a fallout of what's going on in the Middle East and North Africa.
Okay, thanks. There's an interesting situation with another big-name stock, and we're going to talk about that next. And now, Stock Talk, analysis of stocks in the news. Well, as of published reports on March the 28th, shares of Best Buy were down 15% on the year and more than 30% over the last 12 months. Now, the company recently reported a drop in same-store sales for the most recent quarter and has predicted a flat to down year for 2012. We put our equity strategists Tracy Reinick and Michael Vodicka on the case to see if they could shed some light on what's actually going on behind the curtain with this stock, and they're here with us now. This picture doesn't look too good for Best Buy, either from a fundamental side or from a momentum side. They've been in kind of a free fall here since March the 24th.
Yeah, it's hard to be a big box retailer right now. You know, they have those massive stores, and they just can't sell enough TVs and electronic gadgets to pay for it.
Is it really all that's going on here?
Well, partially. You know, their sales per square footage has been dropping since 2006, and then people thought when some of their competitors have died off, like Circuit City, that they would see benefit from that, but that isn't really happening either, because they still have great competitors in Target and Walmart and Amazon.com, the online retailers.
Right.
So they're still in a super competitive environment in an area where, you know, yes, electronics are hot right now, but that's the smartphone, the tablet. But TV sales, as they just said, are not good, and they make a lot of money off the TVs.
Well, outside of the retail scenario that you brought up, which they say they're taking steps to rectify going forward, they are supposed to be downsizing some of their stores going forward. There are no real warning signs about the company not being profitable, though.
No, you know, they are making money. They have a decent cash position, so that's not an issue. They are starting to address these issues, as you said. They're opening up a whole bunch of their mobile stores, which are the small size ones, but that's still a small percentage of the overall sales. So, you know, and they have a decent international business too, but it's going to take time to do all these things because they are so heavy into the big box.
All right, Mike, we've got a company here, a stock whose shares have lost about a third of their value since November. It touched a 52-week low recently, I mean very recently. Put the picture in front of us. What does it look like in picture form for this stock?
Sure, absolutely. Well, just like you guys said, the short-term trend is most definitely bearish. I brought a 6-month chart with me here I thought we'd take a look at. And what you see on the chart is the big event was really their earnings miss from December 14th. Their share price took a really big hit on that event. And since then, it's been a fairly bearish trend for Best Buy. And like you said, recently touching the 52-week low just around the $28 level.
Yeah.
Taking a longer term view too, I also brought a 2-year chart with me, is you see a fair amount of volatility in Best Buy's share price. The 52-week high is 48, the recent 52-week low is $28. So this is a stock where you definitely want to be careful. If you're looking for hope on the bullish side of the equation, the stochastic below the chart is indicating that shares might be a little bit oversold down here, so that's something for the bulls to hang on to.
But we've got a company with a steady cash flow, shares trading at about almost 8.25 times forward earnings.
Right.
So really not a need to sound the alarm bell just yet, but it does raise some interesting questions.
It does. I mean, they have these good valuations, but they're only supposed to grow earnings about 1% this fiscal year, maybe 4 to 5% next fiscal year. Like I said, they're trying to get their house in order, and they're taking steps to do that. But a lot will depend on the consumer and what they're buying, you know, what they do as far as TVs and everything else.
All right. Well, thanks both of you for that information. The roundtable is next. Don't miss it. If you have a question or a comment about our show, send it to us at mailbag@zacks.com. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Earnings, the market, and top stock picks. That's all ahead in this edition of the Roundtable with our editor-at-large, Steve Reitmeister, who returns with us here, as does Shiraz Mian, our research director, and Omar Sharif lookalike, and Kevin Matris, our top market technician here. People ask me, is that Omar Sharif at the Roundtable?
Hey, that's not a bad thing.
Tell them they're related.
Omar Sharif is a sex symbol.
Yeah,
now,
that's right.
He's 70, 80 years old, but you know.
We will go with the symbol.
Yeah.
That's fine.
I want to start with you, since it's been a while since we've had you here at the Roundtable. Give us your outlook for this first quarter earnings season coming up.
Yeah. I mean, the projections look fairly positive. You know, the growth is supposed to continue, but as I put in some of my recent commentaries, I'm just a little worried about the rising inflation that we're seeing in natural resources and commodities that are going into the cost of goods from these corporations, and what is their ability to pass that cost along to consumers. If they're not, it compresses profit margins, and it would be, I'm not going to say horrible for the stock market, but it certainly could stall us out for a while until we see what they can really do with profits. The good thing is that the earnings reports that have come out in March, people who have slightly different earnings cycles,
Right.
There's not much worry in those reports. And so I think that's fairly positive, and there's been virtually no pre-announcements from firms saying anything's detrimental. So just a little hint of caution, but most things look good.
All right, Kevin, is this earnings season making you a little anxious?
Actually, no. I think this earnings season is going to be a catalyst for the market, and I believe the catalyst is going to be to the upside. And I came here armed with statistics, so check this out.
All right.
The last two earnings seasons, which were Q3 and Q4 of 2010, both of them were pretty good, and each time we saw the market rise 5% and 6% respectively within the first 30 days from the official start of earnings season. Back then, I believe we saw about 65 to 70% of the companies in the S&P post positive earnings surprises, but even more impressive is this. We saw a 16% increase in companies posting positive sales surprises from Q3 to Q4. I think that trend bodes well for this earnings season, so I'm very, very optimistic. I think we're going to see another great earnings season this time around.
Shiraz, I mean, you and I have talked in the past couple of weeks. You were optimistic. Does that optimism remain?
Yes, it does. But I would agree with Steve's assessment that there are questions. There are questions of what this commodity price inflation would do for the margins. Now, I must add that in the aggregate for the entire U.S. corporate sector, for example, as say for the S&P 500, there would be some sectors which would be more affected by these trends than others. So technology and financials and utilities, and many of these industrial companies have no exposure whatsoever to this. But you would have fuel increases and food price increases would have an impact in retail. It may have impact in consumer discretionary. So in the aggregate, we may not really see an impact on the earnings growth, but if we go at a more granular level within sectors, I'm suspecting that we would see a little bit more negative surprises that we've been used to in the recent past.
And is that what you meant when you wrote earlier this week that earnings season is a big deal for the market?
Yes, it is. So that's why we see this tentativeness in the market over the last few days. It's these questions that Steve raised. And all of us want to see how much impact in the technology sector the Japan situation has. What, if any, the Middle Eastern turmoil is doing. And we want to hear from these management teams about the outlook for the coming quarters for next year. What do they see? Do they see a slowdown, a softness, or a continuation of the trend of the last few quarters? So that's what's keeping stocks tentative over the last few days.
So all in all, Steve, you think that earnings reports are going to be enough to be the catalyst that propels the market higher?
Well, there's two things that are important for the market to move higher, because I'd say we're pretty close to fair value at current prices. So you need earnings to move higher to propel stock valuations again. And hopefully we do get that. And the second thing is we need to make sure that inflation does not continue to ratchet up, because the higher inflation is, here we just talked about in the profit margin picture, but also that when consumers see inflation ratcheting up, their confidence in the future and their ability to stretch out their dollars becomes impacted, and so they start become fearful about their spending. So those two things hold up well. The stock market will continue forward on the year.
Okay, Kevin. What Steve is really saying is investors need a strong reason to press higher. So is that what we're going to see here over the next couple of weeks, that strong reason?
Look, we have had so many things thrown at the market in the last couple of weeks, last couple of months, and here we are back at the old highs, actually new highs.
Yeah.
And each of the last two earnings season, you saw the market propel to higher highs. This cannot happen in perpetuity, but I do believe this earnings season we're going to see the same thing. I'm looking for 13.1. That's only a 5% increase from here. That is consistent with what we've seen in the past season. So
I remembered
we're
that.
going higher.
Give us your top stock pick.
Mine is BJ's Restaurant, ticker BJRI. They're in the retail restaurants industry. They own and operate high-end casual dining restaurants. They operate BJ's Restaurant and Brewery, BJ's Restaurant and Brew House, a bunch of other things. What I like about this company, solid growth rates, increasing margins, very important. They have an exciting expansion plan, and according to the Labor Department, the food and services industry is one of the largest creators of new jobs. That makes this especially interesting.
All right, Shiraz.
A pure play refiner. This is a seasonal pick. The stock is Tesoro. It's a West Coast focused refiner. They don't produce oil, not drag it from the ground. They just refine and sell at the retail level. It's a seasonal pick because refiners typically get an uptick in the spring, summer months. It'll be a good pick for the next 3 to 6 months.
Okay, Steve.
I'm going to go with Raymond James, the brokerage firm. I mean, I kind of agree with Kevin's assessment that by the end of the year, we're going to be looking more at 13,000-ish for the stock market. As the stock market continues to make new highs, retail investors come back in. That's very good for brokerage firms and their profitability, and they have very good leverage in their margins as trading activity increases. So I'm a fan of that one.
Okay, what's on your radar for the week ahead? Just besides earnings.
Earnings and inflation. Those are the two things happening next week. Both CPI and PPI. Got to keep an eye on both those things.
Okay, we're going to have to leave it there. Thanks for joining us. Hope the week ahead is a profitable one, and we'll see you next time on Profit from the Pros.